Hello everyone, welcome to the Financial Information channel. In this video I'm going to give the top 5 common investor mistakes that many people do, including myself. And before I start the video, you gotta know that everyone makes mistakes. That's how you learn in the stock market. Don't get discouraged when you make a bad investment. Everyone has that at some point. It is way better when you make those mistakes at the beginning because you get that experience so you can invest in the stock market for the long term. Now we're going to start with the video, and the first mistake that we all make at some point is having no game plan. And what I mean by not having a concrete plan is you gotta realize that in the stock market there are different ways that you can invest. And the first way that you can invest in the stock market is through a retirement account. And the first account that everyone should open should be a retirement account. The retirement account is gonna allow you to basically start investing and get some basic knowledge on the stock market. In addition, when you start opening a retirement account, you have the protection that if you end up losing an investment, for example, you invest in a bad company, you will have more time to recover from that loss. And in that account, you can set up goals. For example, one of the goals could be at what age are you planning to retire? Keep in mind there are many different accounts you can start investing. You can start investing, like I said, in a retirement account, either a Roth IRA or 401k. Also, you can open a 529 account, and a 529 account is to basically invest some of the money, and that money is going to be used for college tuition for a family member. And once you have opened a retirement account, then you can start thinking about getting a brokerage account. And the brokerage account, what it's going to allow you is to basically start investing into the stock market, executing some long-term investment trades or some short-term trades. And that is the first common mistake that many investors do, having no specific plan. And in order to avoid the first mistake is to set up a plan, basically your goals, make sure that your account is diversified, and in addition measure the risk associated with that account. And the second common mistake that many investors make is not having enough research for a specific company. And this mistake is one of the mistakes that I actually did back in 2009, is not doing a lot of research for a specific company. You have to understand, if you plan to invest for a company for the long term, you have to read a lot of earning transcripts, because that is going to help you a lot. In addition, you have to read the 10 keys for the company and see how the company has managed the money through the last few years. It might not seem like a huge amount of work, however, it is a lot of work, especially if you plan to keep that company for a while. Now, the third mistake, that is not having enough patience for the company. And I'm going to use one of the companies that is actually having a little bit of trouble, I would say. That will be Walt Disney. And Walt Disney during the last few years hasn't moved that much. However, if you plan to have this company for the next 30 years, having this type of return that Disney has provided in the last 2 or 3 years is not going to affect the overall picture. Just keep in mind that having a lot of patience is going to pay off, especially if you select a blue chip company. And that was the number 3 common mistake that investors make. Now for the next mistake, which is the number 4, is chasing performance. And chasing performance of a stock is a mistake that we all have made at some point. And the reason is simple. You see a stock that has gone up quite a huge amount through the last few months, and the logical reason is to buy more shares because you think the stock is gonna go up. And while that might be correct, the stock might continue going up. Think about it. A stock is never going to go up all the time. It has to pull back at some point. And even if the stock of that company doesn't go down as you had hoped, you just gotta realize that maybe you made the opportunity to invest in that company at the right time. You just have to accept that fact and move into a different company. And the number 5 common mistake that investors make is not rebalancing your account. And that is really important. Think about it. When we have a bull stock market, it is a good idea you invest into growth companies, because those companies are going to give you even better return than value companies. However, when the stock market doesn't go up as much, you need to rebalance your account and start implementing more value companies. And those value companies could be PepsiCo, Boeing, Triple M, among many others. And those companies have been in the stock market for a while. Now, those value companies might not give you a huge return for the next few years. However, it's going to bring stability and safety into your account. So it is always a good idea to actually analyze your account and see which of the companies are performing the best for that specific situation. And keep in mind, these are just 5 of the common mistakes that investors make, and there are many more mistakes that investors make. And that is going to be everything for the video. Please leave in the comment sections which mistakes have you committed the most. I think for me has been probably chasing performance, because I think it is enticing to see a stock performing so well and you missing some of that return. However, you have to be disciplined and stick to the game plan that you have for your account. You can subscribe to the Financial Information channel. I'm going to continue bringing videos about the stock market, personal finance, and how to make money online. I want to thank you once again for watching the video. Have an excellent day and take care, my friends.